Tech is headed for a losing week after the Fed's hawkish pivot sent stocks plummeting. The Nasdaq down nearly 3% in the last 5 days. Is tech still a buy after these losses? We've got Young-Yu Ma, Chief Investment Officer at BMO Wealth Management US, joining us now. Good to see you, Young-Yu. So as we look at what's been happening with technology, right? There has been this call for broadening in the market. That hadn't really materialized. And then, of course, tech helping lead some of the losses this week. So how are you thinking about positioning there going into 2025?
Yeah, thanks. It's great to be here. We think going into 2025, we still want to be leaning into risk here. We think the pullback in the tech sector in particular probably presents opportunities here. We think there's still a lot of growth to come. We think there is broadening, especially among tech companies that help other companies become more efficient and improve productivity using some of those AI tools in ways that benefit companies. We don't think it's just going to be about the megacap tech names. Those will do well, but we do think it's going to broaden to a tech space that includes a lot of other tech companies, mid caps as well, that benefit from these technology trends and AI implementation.
I want to get your take on some data from Bloomberg Intelligence indicating analysts are still expecting 23% earnings growth for 2024. Obviously, we're still waiting on that final quarter of earnings. That has only happened after recessions or in 2018 after tax cut regulation from the Trump administration the first time around. How can tech hit those levels of expectations in 2025?
Well, expectations are reasonably high, and we think that is the big question, whether or not tech does reach those expectations are currently being priced in, because if it does, valuations are not extreme or even stretched right here. That would look quite reasonable if those expectations for 2025 are met. How can it hit those? We think the big thing is an expansion of profit margins, and we do think we're in the beginning stages of a multi-year productivity cycle, and that productivity is going to hinge on the implementation and rollout of these new technologies. So we are pretty optimistic that this can actually happen. Of course, not every company is going to be a winner in the scenario, but if we think in the big picture, the world is going more tech, and tech is being implemented more and more and becoming more of everyone's daily lives. And that trend means that there are going to be a lot of companies that benefit from it.
In the past couple of years, we have seen rising yields at times provide a stumbling block for large cap tech, for the markets overall as well. So I'm curious how high you think yields could get. We've obviously been seeing them move up, and whether, again, that's going to provide a little bit of friction.
Yeah, we think there are a few things that are in play in terms of how high yield, long-term yield, say the 10-year treasury yield could go. We think there's probably some upward drift for the next few weeks here, but there's, we think, somewhat of a lid on that will be dependent then upon what happens with tariff policy with the incoming administration. We think absent any big shifts in the tariff policy, that's a big if, we will grant you that. But absent any big shifts in tariff policy, perhaps the 10-year yield could drift up to around 4.75, but we don't think it would go much further than that until we see what tariff policy looks like. If there are some more aggressive actions that are taken right out of the gates with tariff policy, yeah, we could get to 5% on the 10-year treasury yield. We don't think that's far-fetched at all. And that would probably cause a bit of a pullback or hiccup in the markets. But we actually think over time, and even within a relatively short period of time, maybe a month or so, the markets will be able to digest that level, stabilize that level, and then refocus on earnings. I think the difficulty and damage would actually come if that 10-year treasury yield gets above 5.5% and stays above 5.5%. That's where the difficulties, I think, would start to set in a more meaningful way.
And if we do see treasuries hitting above 5.5% on the 10-year in particular, what does that tell us about how the market is viewing this round of inflation and whether or not it could be a problem for even these large cap tech names heading into 2025?
Well, it would signal something along the lines of stickier inflation, perhaps concerns that tariff policy was going to stoke that even further. I think that was probably one of the underlying drivers of that University of Michigan sentiment survey that came out relating to inflation. And what does that mean for valuations, for example? I think people then start looking at the trade-offs between investing in stocks versus putting money in bonds, and there's a little bit more pressure or impetus to see that flow go more aggressively into fixed income until you reach a new equilibrium, and that would probably result in a pullback in the marketplace broadly, including tech. But again, we're not at levels, even if we get to 5%, 5.5% on the 10-year Treasury yield, we are not at levels that we have not experienced before. If you go back to 1995, short-term rates were at 7%, and the 10-year Treasury was about 7.75%. The big question is what happens with productivity, what happens with growth, and that's a bigger driver than the yields. Once the yields stabilize, it is important that the yields stabilize and allow for the economy to recalibrate.
All right, Yuma, we got to leave it there. Thanks so much for joining us.
Thank you.